In this latest of our jargon busting videos, I'm going to explain exactly what a share is and how investors and traders hope to make money. Hello, I'm David Jones, and in this latest jargon busting video with Trading 212, last week we talked about what a currency pair is. I thought this week, let's take it right back to basics and explain what a share is. If you buy a share or sell a share, what is it you're actually doing? What makes up a company's share? Now, the easiest way of explaining it, if you have even one share in a company, you're a part owner of that company. But let's use a really simplistic example, first of all, just to highlight how it all works. So let's look at a very simple and very fictional example to explain how this works. Let's say I decide to start a company and I want to raise some cash to help me get started and talking to customers and all that sort of thing. And I value my company at the beginning, because it's a startup and it's never actually done anything, at £10,000. And to raise some cash, I want to sell off some shares. So I'm going to split the company into 1,000 shares. Now I want to retain control of the company. So let's say I'm going to keep 60% of the shares, but I make the other 400 shares available to be bought by people who want to invest in my company. So if there's 1,000 shares and I'm valuing the company at 10,000, then it's £10 a share. You decide to buy 100 shares. So you think this company might be a good idea. So you buy 100 shares at £10 a share. So in this example, you've invested £1,000. So there are 1,000 shares in circulation, 600 of them are still with me, but you own 100 shares. So you are a part owner of the company. That's what buying shares, if you break it down to its most basic level, is all about. So if you own 100 shares and there's 1,000 in circulation, you're a 10% owner of the company. Okay, so you'd be entitled, if I pay a dividend out, you'll be entitled to maybe, a share of the profits in that way. If the company does well, in theory, its value should increase from £10,000. So you should see the value of your shareholding grow. And the way, of course, it works in the markets is if you've made a profit or you've made a loss or you just change your mind, it's very easy for you to then sell your shares on to somebody else. I don't get the benefit of that. Of course, if you go and sell your shares on to somebody else, I don't see that money. It's you getting that money. But when you own a share or a number of shares in a company, you're a part owner of that company. Of course, let's take Apple as an example that's worth many hundreds of billions. If you have £1,000 worth of Apple shares, then of course you do technically own part of Apple. But £1,000 is such a small shareholding, you can't really march into their head office and say you don't like the look of the iPhone 10 and you think they're selling it too expensive. Okay, so you're a very small shareholder in that example. Okay, so it all depends on the size of the company and how much you invest, of course, as to how much of that company you end up owning. So if you buy some shares in my fictional company, you own part of that company. Clearly, investors and traders alike, if they buy shares, they want to make money, they want to see a profit. So there are a couple of ways that both of these can profit from share prices. So let's take a quick look at that. Let's look at how people will try and make money from shares. So one way, particularly for longer term investors, one way they'll try and get income off their shares is by dividends. As a part owner of that company, I'm entitled to a share of the profits if the directors of the company decide to pay a dividend. So let's say I've had a good year in my new business and I decide to give everybody a dividend of 50p. So 50p for every share they own. Okay, so in the example where you've bought 100 shares, you'd be entitled to 100 times 50p as a dividend for your shares. So getting dividends is one way that shareholders will get a portion of the profits. Of course, the company may decide not to pay a dividend. They may think, well, actually, we're better off hanging on to this money and using it to grow the company. That's particularly true of sort of fast-growing technology companies. They can plough that money back in, reinvest it, and hopefully grow the business even more. But maybe more established companies will always pay out at least something as a dividend. So that's one way we can see a profit from our shareholding. The other way, and of course the main way people look to profit from share prices, is the share price going up. If we paid, in the example, £10 a share, let's say I've had a really good year and I've beaten expectations and profits are through the roof and all this sort of stuff, the company's doing really well. Well, maybe the shares that you paid £10 for, because it's been such a good year, they're now trading at £13. So if you wanted, you could sell your shareholding and make a 30% profit. Okay, so there's an example where the share price has gone up. Of course, if the company does badly, then the share price may well fall. So your shares may fall to £7 a share. Then it's up to you. Well, do I want to hang on to see if the good times come back? Or do I want to take my loss, get some of my money out and look for the better investment? But share price growth, when we see charts like that, that's the traditional way that particularly traders and of course, longer term investors as well, the dividends are good, but it's the share price growth that can deliver, I think, the real stellar returns. So that's how it works in theory. Let's have a look in the real world. Let's have a look at two companies' share prices with very different fortunes over the last 18 months or so and see how it would have panned out for investors in both of these companies. Let's take a look at Netflix. You can search for it if you're on the platform by, not surprisingly, typing its name into the search box. You'll see there are two options. You can trade it as a CFD, contract for difference, using leverage, or if you want to, you can buy the physical shares. So that's where you don't have any leverage. For now, let's just stick with the CFD and take a look at the chart. Okay, so we've gone back in time. It's September 2016. You think that Netflix is going to take over the world and we're all going to be watching streaming videos every hour, every day. So you decide to buy some shares in Netflix. They're trading around about $100 a share. So you decide to buy in. Let's say you buy 10 shares. So you end up with $1,000 worth of shares. Let's jump to the present day. So you were buying down here about $100 a share back in September 2016. And you'll see since then, the share price has just continued to move higher. So you bought 10 shares at $100 a share or 10 CFDs at $100 a share, and it's just moved higher and higher. You've more than doubled your money. At the time of recording this, the share price was trading around about $270 a share. So the $1,000 that you put in, if you sold out now, you get back about $2,700. So you've made $1,700 because Netflix has done well. The share price has done well. What's also interesting here, look at this gap here. We've recently had earnings from Netflix. So companies on a regular basis, typically quarterly, particularly in the US, will announce their profits for the previous 3 months. How are things going, what their expectations are, that sort of thing. Netflix's latest earnings report, it ended up adding more subscribers than the market, market analysts, investment banks were expecting. So we saw a really big jump. Here we go. So just before the earnings, they were trading at 227. They beat expectations in terms of subscribers. The share price opens up almost 10% higher the next day. So you can see, how if a company is doing well, then clearly their share price should do well. If they end up doing even better than expected, it can really put something of a rocket under the share price. So there's an example of how we would have made money owning a tiny, tiny part of Netflix because the company did well, so the share price increased in value. Let's look at one that didn't go so well. Right, we've gone back in time again to September 2016. What we're looking at here, this is the share price of 𝐎𝐫𝐢𝐠, so a UK listed company, big construction business, big services business in the UK. So you decide, they're trading around about £2.50 a share. So you decide again to put your £1,000 this time in 𝐎𝐫𝐢𝐠. So at £2.50 a share, if I can just do the maths in my head, you buy 400 shares at £2.50 a share. So 400 times £2.50 is £1,000 invested in the company. So you think the company's had a bit of a tough time, but it's going to turn it around. Let's fast forward to the present day. Well, this definitely hasn't done as well as the Netflix investment. So we were buying in here at £2.50 a share. The share price hardly went up after we bought it. Just slid. Came out with bad news. That big gap there, you can see. We had the gap going the other way in Netflix. Big gap here in 𝐎𝐫𝐢𝐠, gap down. Results clearly worse than expected. And at the latest, during January 2018, the company went into liquidation. So technically, well, not technically, you've lost everything. So you put £1,000 into the shares. You saw the shares slide. You decided not to get out. You were going to hold on, thinking it was going to turn around. It didn't end up turning around. So even though you own part of the business at the moment doesn't exist anymore. So your shareholding is worth zero. So the Netflix shareholder, very happy, sitting on a real chunky return. The other shareholder probably wishes he or she had never heard of 𝐎𝐫𝐢𝐠 in the first place, as the company has just gone into liquidation. But that shows, I think, the pros and cons of buying shares. Also, I think, whether you're an investor or a trader, you need to have a strategy for getting out if things don't turn out quite as you planned. You saw on the trading platform there, for Netflix, for example, there was the CFD, the contract for difference, and the share price as well, the physical share. So you can actually trade or invest in both. We'll cover CFDs in the future, but it's a way of trading using leverage. But on Trading 212, you can actually buy and sell the physical shares as well. And there's a zero commission deal. So go to their website to find out a bit more about that. But that's our explanation of shares for this week. As usual, if you have any questions or comments, or you're still not sure, leave us a message in the comments down below. We do read all of them. If you like the video, click on the thumbs up. And if you're not subscribed, we do lots of different videos, cryptocurrencies, technical analysis, trading strategies, all this sort of stuff. So if you're seeing this for the first time, if you click on the subscribe button there, and just make sure that alarm bell notification icon thing down there has been clicked, and you'll get notified every time we upload a new video. But for this week, from me, David Jones, and Trading 212, we'll leave it there, and I hope you have a good trading week.